industrials are supposed to be one of the worst performers this earnings season. Does it mean that the green shoots are in play right now for a possible leg higher in markets if one of the most beaten up sectors is getting some relief?
Well, I think already, if you think about this market, we went from 2,300 to 2,800. And when we were down at 2,300, we told our clients we thought it was a good time to rebalance and increase equities because the risk reward was so positive. So before we talk about the next leg higher, I think we have to think about where we've come to. This 2,800 level, I think is going to start seeing some overhead resistance around 2,900 to 3,000 on this market, and maybe move more into a trading range where you start to see dispersion start to come down. When the markets were at the lows, everything was moving in unison. And what we started to see already, and we're seeing the hints, as you just mentioned today, is we're starting to see companies move on their own fundamentals. So I think that's the transition that we're going to start to see in this earnings season. And from our perspective, we wouldn't be as aggressive up here. We would still average in. We would be more aggressive on pullbacks. But we don't think we're going to go all the way back down to the lows. I think if you have a pullback, 2,550, 2,600, that's where we'd be more aggressive.
All right, the life comes at you fast, JJ. I mean, it was about a week or so ago, perhaps, that the commentary broadly based on Wall Street was that we were going to retest the lows again, that this was going to be a situation where you could very much see a leg lower in the markets. And all of a sudden, within the past couple of days, Goldman Sachs, other strategists on Wall Street say that, you know what, the bottoms are in. So can we trust what's happening right now? Is the green on the screen today something that you can really get behind?
Well, I think, Dominic, as long as you have a VIX that, it's just below 40 right now, we're starting to see some of the volatility expectations sink a little bit. I think the important thing that we're seeing right now in terms of is the bottom in is that we are forming trading ranges. For the first time also, Dominic, in the last 2 days, you're hearing people talk about support and resistance numbers. It's something we couldn't do even a week ago because the ranges were so great. So I don't know for sure if the bottom is in, so to speak, but we sure are setting a nice base right now. So it would probably take some really bad news in order for us to fall, significantly from here. I will say I think the major test is going to be when we start getting back to work, because, as you know, it's going to take a while for the economy to sort of rev back up. I always talk about the middle seat test. When are people, not that anybody ever wanted a middle seat on a plane anyways, but when are people going to be comfortable enough to take a middle seat on a plane in terms of everything? So as we start to rev up, those are the kind of things you have to see us get to. That's going to be a few months down the road. But is our initial rev up going to be enough to please sort of the expectations that we have built into these PE ratios?
Yeah, definitely a key question, and certainly something the market seems to be very focused on in general, how this economy is going to open up and how consumers are going to react to it. Keith, from an investor standpoint, on the one hand, you've got low interest rates right now. On the other hand, you have something like 6 dozen companies so far that have either cut or suspended their dividends right now. A lot of focus in this earnings season, not on the actual EPS numbers or even second quarter forecasts themselves, but on the state and the health of balance sheets and companies' abilities to weather this pandemic, at least in the near term. Do dividends actually still matter to investors? What are the priorities as you look through this market for opportunities?
Yeah, I think you bring up a good point. I think the real question is 2020 is going to be a write-off year for earnings. We know that. So the question is, who's the survivors? Where are earnings actually impaired, and where are they going to rebound quicker? And from our perspective, we've had this kickback rally, a lot of what we call the junk rally, which is very normal. But we think where you see more clarity and where you want to be positioned is more towards things like technology, which is still leadership in the market, lagged a little bit the last few weeks. Everyone's doing more things from home, as we know, just even with this Skype call today. And then with healthcare, think about how many billions of dollars are coming into that industry every day. That's another leader of the market. So I think going back to the initial conversation, you're going to see more differentiation, not just an all or nothing market. And you want to go into some areas where there's visibility, and investors will focus on places where balance sheets are stronger.
All right. I mean, the balance sheet thing is such a key focus here because in certain asset classes, and JJ, perhaps this one for you, we're seeing some notable convergences and divergences in the market. Since the lows that we saw about a week or two ago, we've seen a sharp rally, not just in the stock market, but also in the investment-grade corporate bond market, also in treasuries, also in gold prices. All of those things tell you different particular theses. So what exactly do we believe in this market right now? Is it the risk assets that should be performing better, or this idea that we're going back towards things like treasuries, gold, and maybe investment-grade corporate bonds?
Well, Dom, I think a lot of it goes towards I'll use the word tepid, people getting back in. People do want to be in the market right now, but I think everybody's very nervous about being nobody's putting all chips on the table. And you bring up an important point. If you look at where, like, our clients were buying things at the worst end of this, it was those with really good balance sheets, the Exxons, the Microsofts, Boeing was one, Disney. They've been through it before. They had big balance sheets. They had lots of cash on hand so they could survive it. As we started to rally a little bit more, one of the interesting things to me is our clients are dipping their toe a little bit more in chip makers, etc. Starting to go outside those big balance sheets and going towards, obviously, technology, but even a little bit outside what you would consider the mainframe, the Cisco's, Oracle's, old school, if you will, companies that have been through it before. So I think that's the really interesting thing. So with that, though, are they still keeping money buying fixed income? Yes. So it tells me that although people think we are on our way back, they're very nervous to just say, hey, bottom's in, I know we're going up from here. I think people are sensible enough to realize that at this level, you still are going to have volatility. So with that, some of the down moves, if we, as we have some more, will allow people to get in again at prices. If they missed it the first time, I think there's going to be some pent-up demand where you may actually see a little bit of the buy the dip mentality if we do go back down.